So stuff still opening up, so I think we'll have to give it a minute, 2 minutes more, but more down than up, essentially, is the overall picture. Surabhi.
Yeah, I mean, moves are very, very quiet early on this morning. Bank Nifty is underperforming. That's very clear, at least at the start. So continuing its streak from yesterday, ICICI Bank, Axis Bank, Kotak, these are some names on the downside. Yesterday HDFC Bank was a big disappointment. This morning, it's starting slightly lower, but close to the flat line. So let's see if there's recovery. On the upside for the Nifty, Cipla, Vinny alerted us on that stock with the new products that they have in the pipeline. About 1% up on that stock. Adani Enterprises, there's some buying in metals, Tata Steel, Hindalco looking okay. TCS and L&T along with ITC are some of the heavyweights that are pulling their weight on the upside. Actually, tech is doing pretty okay. HCL Tech is also on the upside for now, but it's still extremely quiet and trends are little all over the place. By the way, beyond the Nifty, the one stock that I want to highlight is Religare, because finally it's over, it's done. The Burmans are the promoters of the company and they hold about 25% stake. That stock is up about 4.5%. Not sure if I missed something on L&T Tech, by the way, folks. I mean, suddenly stock is surging at the open. 4.5% up. But mid-cap's doing better. 0.5% up already on the mid-cap index.
Well, that's right. A few stocks just to take note of. JM Financial, that's a stock that's up and about in today's trading session. Volumes as well fairly high, so that one should come up for you on the screen. On the flip side, you have Strides Pharma. That one's seeing some kind of selling pressure as well. So let's keep an eye out on that one. That's a little bit lower as we speak. Other stocks that are moving around, as you mentioned, Religare, top of the pops out there. Bandhan Bank, one of the biggest underperformers in the last few years. It's up 3.5% as we speak. JSW Energy, they have merchant power, so they could potentially gain if power demand is strong. The stock has as just corrected a goodish bit from the recent peak, and then past quarters numbers were very disappointing. For the time being, the stock up 3%. CDSL is back on the list, up close to around 3%. And NTPC Green as well, one of the top volume movers in today's trading session. Sambadara Madison had a good run, but that one, in fact, is now down close to around 1.5%. One of the top volume losers this morning. But guys, not too bad looking screen. We're down 20 points. The GIFT Nifty was teasing us for an 80 to 90% cut. For the time being, 20 points cut. But that's not really the story. The story is in the broader markets. That outperformance continues. It got slammed the previous week. This week, the mid caps and the small caps have done better than the headline index. Portfolio is feeling better than last week at least.
No, to start with, absolutely. 4:1 is the advances to decline ratio. Still early, but I mean, gives you a sense of which way the wind is blowing this morning, and it's outperformance for broader markets, which seems to be continuing. The top volume-led gainer is CDSL, which is up 3%, so just under 1,300 rupees. APL Apollo, we had discussed actually both these names in the morning. APL Apollo is up 4%. Is the second biggest volume-led gainer. Godfrey Phillips ended 10% lower yesterday. It's up 3%. Again, it's got large volumes to begin the day. Religare, we mentioned. There's JSW Energy. And LTTS is coming up with a 4% pop. Again, large volumes for this point in the day. 63 Moons is there, 4.5%. It's just showing up with volume, so making a mention of it. EPAC Durables is up 4%. There is E2E Networks, which is up about 5%. Just one way a slide on E2E, and of course now coming back 2 days. Actually, I think third day of 5% daily gains. There's something like a Shakti Pumps, which fell from 1,200 to 850, is back at about 930 now. So it's one of the big winners over the last 2 years. Kirloskar Engine Oil is up 6.5–7% to begin the day. And Maharashtra Seamless was a big mover. We had the management with us yesterday, and is moving up even more. So up another 4% in Maharashtra Seamless after yesterday's. I think it was an 8% pop that we ended the day with on that name. Mahindra & Mahindra is the biggest volume-led loser to begin the day. Yesterday, of course, it saw a 5% turnaround. It was down 2.5. It ended up 2.5. M&M is got volumes for now, 1.5 lower. So 2,800 is where that stock is at. We have Vetri Subramaniam, Chief Investment Officer at UTI Asset Management Company, who's with us. Vetri, good to have you with us here. Thank you for your time. What's the view at UTI, Vetri? Market view. Is the fall done, or is there more to go for large caps and mid caps and small caps as well? What's the sense?
Sure. Good to be here, Prashant, and talk to you. Yeah, very quickly, I think, we've been concerned about market valuations for a fairly long period of time. The sell-off, which is sort of, accentuated right from September, I would say, breaking it up into the components that you said, As far as the large caps are concerned, we would, the way we look at our consolidated equity valuations, I think it's back within the fair value territory. It's still not cheap, but it's within fair value. And fair value is a reasonable good territory for investors to be willing to, enter the waters and start allocating money to large caps. So from our point of view, large caps, there is comfort. Where we still find the valuations in aggregate expensive is really in the mid and small caps. Particularly, I would highlight mid cap valuations. These are at a record premium to their own history and at a record premium to the Nifty. So we would be slightly uncomfortable in that space. Same holds for the small caps as well, though the small caps have seen a little bit more of a sell-off, but in aggregate, still not something that we are particularly excited about. But I should admit, when I look at the Nifty 500, you've got about 25% of the stocks which are down more than 40%. You've got close to 70% of the stocks which are down more than 25%. So there are more opportunities that you can hunt around for at a stock level. But when you talk about the asset class valuations of 250 small caps or 150 mid caps, I still find those very rich.
Mid and small cap valuations still rich. Vetri, good morning. Just give me a moment. Just going back to L&T Tech, because I was pointing out to viewers that this sudden big surge on the stock. And now Nimesh has alerted us why it's because of brokerage notes. L&T is right now up 4%. There's a Macquarie note, and we'll put it out in just a bit. Macquarie is a 5,100 rupee stock. Macquarie thinks it can go to 6,500 plus. They're quite bullish on L&T Tech. The other one is Bandhan Bank. Bandhan is reacting to a CLSA note. Again, an outperform rating coming in from CLSA, and CLSA thinks Bandhan from 141 can go to 220. So just pointing out on the back of brokerage moves. More coming up on why these brokers are positive on these stocks in just a bit. Vetri, hi, great to have you on. So, you've started off by putting that caution on the table with respect to valuations. Now, the question is, what does one do in this market? And I think people are still wondering if what you're saying is that mid caps are probably still a little overvalued. So do you start deploying some money in large caps, or do you just sit tight, ride this out, and just prepare for a year of low returns? I mean, could it be that kind of a year, 2025? What do you see ahead?
Well, point number one, the market really doesn't care whether it's your birthday, your anniversary, or financial year or calendar year returns. When you look at 10-year returns and you look at rolling returns over 5-year and 7-year periods, what you will find is that they are never evenly distributed. So my first recommendation would be stop thinking about it on an annual basis. You've got to think about it in terms of, I would say, somewhere between 5 to 10-year rolling periods. And, that's what really influences your outcome. So don't invest today because you hope to beat the FD return. A year ago, people were very confident that they could make 20% a year. Who needs fixed income? Now they're suddenly worried about the fact that they're not making as much as their fixed deposit or as much as a fixed income fund. But that would lead me to what I would say, to my mind, still remains a very good opportunity for investors, which is to consider the hybrid set of funds. The reason I say that is that it's got a balance between equity and fixed income. Of course, those percentages could move around based on which mutual fund category you look at. But the reason it's attractive is that your fixed income part of the portfolio is giving you a reasonable positive carry and spread over inflation. And at the same time, you're not 100% exposed to equity. The aggressive hybrids typically run at 65-70% equity. And of course, you could also look at, the strategies like the balanced advantage or the multi-asset allocation strategies, which, could dynamically readjust their equity exposures. So to our mind, hybrids are really, should be the choice of investors looking to deploy in lump sums. If you do want to go for pure equity, then we would recommend large caps, but we would still recommend staggering those investments over time.
So don't be greedy. I think that's in a sense, that's the advice, right? Overall, stop being so greedy. But, Vetri, let me ask you something that another market commentator brought up, and I think it was a very, very relevant point. We're now paying capital gains tax at 12.5%. So when you speak about look at long-term rolling returns, equity returns still need to be substantial enough to be meaningful net of tax. So then, what is this, average 10-year rolling return if I sit in my fund or if I sit on my stocks and forget about it for the next 5-7 years? What is that realistic expectation that that investors can still have where equity still makes sense net of tax?
Sure. Well, remember, you are in an economy which is growing in nominal terms at about 10%. So, that's sort of the aggregate outcome for incomes in the country. You are in an economy where the central bank is targeting a 4% inflation rate, let's say 4 plus or minus 2. So you've got a 10-year bond yield at about 6.8%. You add some equity premium to that of maybe 5 to 6%, you'll get to 11 to 12% number. So whether I come at this from what is income growth, or I come at this from a classical construct of bond yields plus risk premium, you will end up with a equity return at an asset class level, which is somewhere in the region of, let's say, approximately 12%, which actually corresponds very well to what we've seen in terms of the average rolling returns over a 10-year period. So that's the number to work with. Now, if you're saying 12% is not exciting enough for me, I think you've got to rethink, because look around you and see how many businesses are capable of generating, more than 15% return on capital consistently over long periods of time. And the answer is that's a handful. So I think people need to be practical and realistic about equity expectations. The asset class can deliver you 12%. If you want to improve on the 12%, you've either got to be a great stock picker, or you've got to be able to use asset allocation to be able to maneuver to the asset class when it is more attractive, which also means you'll have to invest in that asset class when the news is extremely challenging and things are looking extremely pessimistic, and you'll have to take money off the table when things are very, very rich and markets are expensive. So you will have to use one of these two strategies, either stock picking or asset allocation, to improve your returns about 12%. And of course, those of us who are in the active management business would say if you choose the right fund, you could also get an alpha out of it. But 12% is the benchmark. So I'm sorry if I'm, disappointing somebody, but I think when we talk about investing to achieve our financial goals, right, and that's the starting point of all investing, you should not be modeling for equity returns of higher than 12% unless you can bring one of those three strategies that I talked about: stock picking, fund picking, which is alpha, or asset allocation.
Go back to rules of investing 101. That's what Vetri is saying.
Well, Vetri, I'm very, very realistic. I'm a loyalist with regard to my SIPs for my children, and 12% I'll be very, very happy on an average over the last, the next many, many years. A 15-year time frame is what I have, and 12% compounded growth is good enough for me, so that's the way I would look at it. But let's talk about stocks and sectors then, which is the theme that is standing out right now. These pullbacks in the market actually are sometimes, make select sectors look very, very good. So if you say, a sector that you'll be, most optimistic on, give and take everything, hearing about tariffs, the economy that slowed down a little bit, the hope of the recovery later this year, what would that be?
Well, Nigel, I did a long conversation with Surabhi many months ago, and I said, the one sector that I find, despite all its challenges, looks reasonably well placed is banking and financial services. Nothing much has changed in my view. That still remains the one sector where I think, the starting point in terms of valuations, Nigel, is attractive. And to my mind, when you take care of investing by minimizing your risk, by getting in at sensible valuations, the future takes care of itself, as long as you're invested in sound, solid businesses. So I would still point to banking and financial services as the sector where I have the maximum amount of comfort. Into the sell-off, we are seeing some assorted pockets, in autos and in maybe things like power, which are starting to look more reasonable. But if you ask me to, name a sector, this is the only one where I'm still very, very comfortable. Outside of that, it's more about stock selection.
But on financials, Prashant, if I could just kind of press that point. I remember that was a Market Cafe conversation, and we spent a good half an hour, more than half an hour, understanding why you're so optimistic on BFSI. But Vetri, since then, I'm just throwing the narratives at you, right? People are now saying that you have to go slow on your high-yielding segments like unsecured. So, will you really make enough margin? People are saying that, maybe the growth itself is not going to come back. Plus, there is the fact that FPIs are disenchanted with the Indian market. So, therefore, bank stocks are not working. How do you sort of deal with some of these issues that have cropped up since then?
Sure. So I would, completely agree with you on that. I think what's been disappointing over the last 6-7 months has been the fact that because the monetary policy restraints have been, not even monetary policy, it's actually RBI's restraints on the banking system have been so tight. You've got this tight liquidity situation. You've effectively sort of talked the banks into saying, slow down your credit growth, correct the credit deposit. Whereas the reality is it's the RBI which has got to ease up the liquidity. Now, for whatever set of reasons, they were not doing that, but I'm glad to see that in the last few weeks, they've certainly started to open up the tap in terms of liquidity. And I think once you start to see RBI's contribution to creation of money supply go up, some of these liquidity issues will take care of itself. I think RBI's intervention 2 years ago in terms of slowing down some of those unsecured credit avenues, certainly in retrospect was a timely intervention. But I think they also realize that at some point of time, if you don't allow credit to flow into the economy and grow ahead of nominal GDP growth, it will constrain our long-term growth prospects. So I think, I'm of the belief that sooner or later people will, come to their comfort level and say, okay, this is a time where we've got solid set of banking and financial services institutions with strong balance sheets. Let the credit growth, continue. And I think that could easily grow well ahead of nominal GDP growth. And that's a very favorable environment for the financials.
All right, Vetri, we leave it there. Thank you very much for joining us. Good speaking with you, and it's a pleasure hosting you here on CNBC-TV18. Well, IOC is the next company on our radar, the country's largest oil retailer, really, and one of the largest public sector companies as well. Third quarter was weak, but I think the interest really with regards to IOC, and of course, I think I can safely say IOC management can speak for the OMCs, the other two OMCs as well, is about the future. We have Mr. A.S. Sani, Chairman of Indian Oil Corporation, now joining us. Mr. Sani, it's a pleasure having you with us here, sir. Thank you for taking out the time. Sir, all eyes on the LPG subsidy, I think. Will we see the LPG subsidy coming in? And by when?
Actually, we have to see it in a very big perspective. It's a large perspective. This system of buffer account was established in 2020 May. And since then, it has been working fine with the industry as a whole. And once we have been given the subsidy amount of something around 22,000 crores or something for the industry in 22-23. And now again, there is some deficit, and we are very much confident, and our government is totally seized to the situation. And we are in talks with them, and we are very confident that by the end of this quarter, we will be in a situation wherein my balance sheet will be healthy enough to support my working capital as well as my capex requirements.
Okay, it will come, right? And we've asked, our colleague Shireen asked the secretaries after the budget, etc., the government secretaries about this particular matter. And the government has been maintaining that it will come. You're absolutely confident that there's not going to be any slip at all?
No, we have been given assurances, and we are pretty confident.
So on that point, if you could just tell us... Yeah. Yes, please continue.
No, I'm saying that it all goes into the big story of capex, because we as sector are growing, and we as sector are required to grow if the Indian growth story has to continue, because we are there to supply energy to the nation. And once this energy supplies and the energy requirement of this growing nation are growing, and they are going to be in another decade or so, they will be doubling. So with double the energy requirement, we have to go on investing, we have to go on doing capex for meeting the requirement, for making these fuels accessible to the general population and to our customers. So this is going to be imperative that we have to have our... Yeah.
So just trying to understand...
Just 1 minute, sir. Mr. Sani, just to complete this point, as an investor in oil stocks, told me, and I had to check the numbers, but I think they're broadly correct. For under recovery of 28,000 crores or so, LPG under recoveries, market cap loss across the three OMCs has been about almost 3 lakh crores. So I'm sure the government is obviously, you'll have to, it depends on what point
the matter.
They're seized the matter. And you're saying the amount will come in full before the end of this particular quarter, right? You're giving that assurance.
we are getting those indications. But as a point of when we are talking of capital appreciation or when we are talking of the stock performance as it is, I can give you a good number which you can refer to, that in the last 10 years, Indian Oil has got the capital appreciation of 11% XIRR plus around 7 to 8% depreciation. So 18 to 19% XIRR return has been delivered by Indian Oil in the last decade to its investors. And this story, we are confident that it will continue.
Absolutely, sir. I mean, the oil marketing companies, refining and marketing companies, they have been wealth creators. But just to go back to the numbers, sir, now 9 months your under recoveries, LPG under recoveries were, I think, around 14,300 odd crores. Where do they stand now? And our colleagues in Delhi were actually reporting that the government could be looking at setting up a new fund, the Oil Development Fund. And I think maybe this is FY26 onwards. So if you could tell us for this financial year, what is the, the help that you will need to mitigate the under recoveries for FY25? And what are you hearing about this fund from FY26 onwards? Apparently, it's for LPG as well as fertilizer, any sort of shortfalls or under recoveries. So if you could give us some more clarity.
No, that for fund, I can only say that it is only, as you are also hearing, we have also heard about it, but it is only maybe very on the drawing board. If at all it is there, it is on the drawing board. It is nowhere near implementation as of now. That much I can tell you. Then regarding the numbers can, your number and my number can vary, and we don't want to commit on those numbers as of now. But yeah, it is somewhere in that range, whichever you are telling. And we are very confident that we will be giving a good, healthy year-ending report by the end of 31st March.
Okay, all right, Mr. Saini. Hi, good morning and good to have you on the show. Let's talk about the company as well as the Indian economy, because I'm looking at the January as well as February growth and FASTag collections. It's been very, very strong. Obviously, it has an element of the WPI-linked toll rate hikes that we have seen. My question to you is, have we seen very, very strong retail demand for fuel in Q4 so far? We're more than halfway through Q4. Is that the sense? Just trying to collaborate both the details, the FASTag collection, as well as what you're seeing on ground? Diesel
was subdued in last quarter and the quarter before. It was around 2% or 2.5%. Now it is picking up to 4 to 5%. It has already picked up to 4 to 5% growth in this quarter. Diesel, it was always 6 to 7%. Now I am seeing it around 7 to 8%. So MS is 7 to 8% right now in this quarter, and diesel, it has risen from 1 to 2% to 4 to 5%. So this is the kind of growth that we are experiencing right now, and this is a pretty healthy growth to see. So better times is what we are seeing in Q4 in comparison to what you see in the past couple of quarters, which is heartening both for your company, for the the companies in this space, as well as for the economy on the whole. We got that point out of the way. Let's focus on Russian crude. Of course, because I want to ask you about the sourcing of Russian crude. No, of course, could you help us out? Yeah. How much are you getting from Russia as of now? And that advantage that we had with regard to imports coming in from Russia, that there has been a bit of a decline. So could you tell us what was the difference earlier and what is it currently? I believe it's come down by a couple of dollars. Go ahead, sir. Yeah, Russian crude is not a game changer. Neither it was earlier nor it is today. Because as you see, it is the game, it is a total sum game of what is my crude buying price or crude procurement price versus what are my cracks. And that gives me the GRM. And GRM is one part of the story that is giving me the refinery margins. Plus, I have a second basket which gives me the marketing margins. So, refinery margins plus marketing margins give me the combined profitability of any OMC that we are working in India. So, that Russian crude coming or not coming or coming at a lesser level is not going to affect my profitability to a very large extent. And I am talking about myself and for other OMCs also. Because availability is not an issue today. Availability of energy, availability of crude is more than what is required by the world today. So that supply demand is driving the total cost of procurement of crude for me and for other OMCs also. And
As a
wherein we are pretty comfortable sitting today.
Yes. As a percentage of a mix, how much is it?
Like we have to go back into the history. Before Ukraine, it was less than 2%. After Ukraine, last year, it was 30%, 34% odd. Today, it must have come down a certain notches, but still it is forming a good portion because we are taking all the clean Russian barrels. Clean Russian barrels, I define wherein the entity which is supplying to us, the insurer of the vessels and the vessels themselves, they all have to be non-sanctioned, and if they are non-sanctioned and they are below $60 or below that cap, whatever has been applied by the sanctions, if they are there, we are honoring them and we are taking them. Other than that, any shady deal, we are not there.
Okay, good to know, sir. Absolutely. You have to abide by international rules, right? Speaking of international rules, let me ask you this. We were asking exactly this to Mahanagar Gas also yesterday. Given the geopolitical dynamics, it's very clear that India is going to be sourcing more US crude. The minister has already said that, right? Now, I want to understand what that is going to mean for a refining giant like IOC when you have more US crude in the mix, and then, you know, Russian crude will be what it is, like you're saying. What will it mean for your profitability? And give us an outlook on GRMs as well. GRMs were a disappointment in the third quarter. Do you see them recovering in Q4, Q1? By how much? And what does it mean to have more, to have to ship more US crude to put through your refineries?
First of all, any crude coming to India will come on economic considerations only. That is one. We will have intent. The intent has been given by government. We will follow that intent. But any decision of crude procurement is taken based on economics only. That is the only driving force for me. And I have an advantageous position because I have 9 different refineries with 9 different configurations, wherein we can very well take almost any kind of crude that comes to Indian shores, including the American crudes or Canadian crudes or Mexican crudes or today's Guyanas or Argentina crudes, which are the new entrants to the crude market. Including everything, we can produce or we can consume and we can process almost every kinds of crude because we have a very wide variety of processing schemes available in our refineries.
No, sir,
so we are
absolutely.
very comfortable.
Absolutely, sir. Your refineries are state of the line, top of the line. We were trying to understand in terms of costing, when there is more US crude in the mix, what does that mean for margins and profitability?
They have to be competitive. That is what I am saying. For each refinery, for each processing, for each tanker that is coming to my shores, it has to qualify on the margins. If it is qualifying on the margin, it's the best deal for me, then only we are going to take it. And that we are sure that the logistics will have to be worked out in a better way. The pricing has to be done in a much better way so that it becomes palatable for the Indian market. And anybody in India will buy any crude only based on economics, nothing else. It is, we are not, just because it has to be taken from a particular geography, we will take it from there. We can take it, we are free to take crude from any geography or any country based on the economics only.
And so the GRM levels, just very quickly, 10 seconds, where are GRMs now, Q4?
GRMs are improving. Last quarter was bad because we are getting the cracks which had gone very low. Last year they were around $18, $19 for diesel. They had gone down up to $7, $8. Now they have improved to, today it is $11 or so, $11.5. So the cracks are improving. The crude is coming down. Crude earlier it was when we were talking last time, it was around $80 or plus. Now it has come to $72, $73 Brent. So now the crude has come down. The cracks are improving. So I see a better Q4 and a much better Q1 going forward.
All right, Mr. Sani, it's a pleasure. Thank you very much for addressing all those issues. And it's great to see you on the program and on the channel. And I hope we're able to do this occasionally and frequently. Really good to see you. Thank you very much for joining us here. Well, we'll take a break. We are back with the management of Chalet Hotels, and we touch upon the latest acquisition and growth plans. Stay tuned.
Welcome back. Well, let's focus on the hotel space. It's been buzzing all week, and Chalet Hotels, that's the next stock on our radar. They've done a new acquisition where they have bought Mahananda Spa and Resorts for an enterprise value of 530 crores. Mr. Sanjay Sethi, the Managing Director and CEO of the company, joins us on the show. Hi, Mr. Sethi. Good morning and congratulations on this win. You've paid around, I think, the total enterprise value is 530 crores. Break it up for us. How much of cash are you paying? How much of debt are you taking on board? Basically, break up this 530 crores for us.
Good morning and a pleasure being back. This is an all-cash deal. There's no debt on the books of that company, so we've actually paid out 530 crores to acquire this lovely asset, which is the Westin Spa and Resort Himalayas, which is roughly around 45 minutes from the Dehradun airport at a wonderful height of 2,500 feet above the Rishikesh base. So therefore, the temperatures and the weather conditions are stunning, the resort's stunning, and we are really happy to add that into our portfolio.
All right, difficult to sit in studio when you describe a resort like that, Mr. Sethi, but good on you. Give us a couple of more details. This 530 crores, as you mentioned, it's all cash.
This is
how is your balance sheet looking right now? If you could tell us how much of cash you had and how much goes out post this. So the balance sheet pre and post this particular deal. And also, if you could help us out with scaling up of the revenues of this, what kind of profitability does this particular resort enjoy?
Sure. So this is a 141-room resort. Firstly, the price positioning for it is around the 25 to 30,000 rupees a night. That's the average room rate that we expect out of this hotel. It is in early stage growth, so it is ramping up. We expect the occupancies to stabilize sometime in the future, in about a year or so from now, at 60%. Currently operating at roughly around 45%. So we see a strong upside on the opportunity. We expect this hotel to sort of be within the parameters that we've done previous acquisitions at, which is basically by the stable year to hit it, and the first stable year to hit at least 10% ROCE, and then move upwards from there onwards. On the balance sheet side, we were roughly around a little under 1,600 crores prior to this acquisition. We'll hit roughly around 2,100 crores as net debt post-acquisition.
Okay, all right, got it. So, and you briefly mentioned that you're looking at increasing the occupancy. As of now, is it profitable? It's at around 45% occupancy with the ARR, I think, of around 25,000 that you mentioned. So, what are the rough margins you enjoy on this?
So at the EBITDA level, operating level, it is certainly profitable. We need to make sure that we hit the ramp up takes us to the 60% occupancy, in which case it'll start throwing up north of 10% return on capital employed. And that's what our target is.
Okay, all right. And do you need to invest more in this property? The 530 crores suffices, or do you have to incur some more capex out here?
So this is a brand new hotel. It's only just completed 2 years last month. We don't need to put in any material capex on this.
Okay, all right. So we got most of the details with regard to this asset. For the company on the whole, what's the average ARR and occupancy you're looking at for FY25, FY26? So,
consistent with what we'd sort of said earlier on, I think the industry will grow at 10% and northwards on a RevPAR basis. We've seen that panning out over the last few quarters. In fact, last quarter was significantly higher than that. We expect this quarter to perform very strongly, being the strongest quarter in the year. And then there onwards, I'm pretty sure that we'll be comfortably over the 10% RevPAR growth for the next few years.
Okay, and number of keys, I think you were gunning for around 30,080 approximately by the end of this fiscal. What's the new targets now? If I look at the number of keys, new hotel launches as well, and the rough capex you've outlaid, how do you see this number ramp up in the next few years?
So, our number of keys prior to this acquisition was 3,052. With this addition of 141 rooms, we've hit about close to 3,200. And we've got another 1,100 rooms under development. A few of them will hit us in the next couple of quarters. In fact, as we speak, we're adding 130 rooms to our Bangalore asset, and they'll get operationalized in the next couple of weeks or so. Look, most of our growth is actually going to come in the year FY27 when we open the Delhi hotel with 390 rooms and a couple of other assets that are under development. We also have a strong pipeline of office assets in our portfolio. We currently have 2.4 million square foot, which is ready and very quickly getting leased out. We've got another little short of 1 million square foot, which is in the making right now. And we expect that to hit the leasing stage in FY27 again.
Just very quickly, what is your borrowing cost, current cost of debt, and this additional 500 crores that you're taking, what is it at?
So the blended cost of debt for us is around 8.5%. And this is pre the recent cuts that the government has, the RBI has announced.
Okay, all right. Thanks a lot, Mr. Sethi, for joining in. Congratulations. Looks like an enticing one. Wishing you all the best, and we'll hold you to some of these numbers.
And he's left us with an enticing image in our heads, right? I mean,
but
difficult to get that out on a Friday.
Need to pull through the day, Prashant. Sanjay is lucky he's heading one of these hotels, but we need to keep it as cozy as possible in the studio. Yeah. Pleasure talking to you as always.
Thank you very much for joining us. A good conversation. Well, we have the next one ready with us. We have, and we're talking about this sort of, it's been all about China plus one, and in a way over the last couple of years, especially under the Biden administration in the U.S., it's all been about sort of containing China. Businesses have moved away. Investors have kind of stomped out of China in a big way, but all of that is changing at the margin. You got mainstream brokerages. I mean, I saw a Morgan Stanley note a couple of days back. I mean, actually 2 days back, they've sort of lifted their bearish call on China. They're saying, well, there are signs of a big structural, durable turn as far as the Chinese market is concerned. So let's talk about this in some detail with somebody who spent time in China on the ground. Andy Rothman is founder at Sinology. Andy, great to have you with us here. Thank you very much for your time. Appreciate it. So is this for real, Andy? This turn that we're seeing, because we've had many false starts over the last few years. And each of these false starts, while you're in the midst of it, seems like this is the real one. In index terms, these starts have been to the tune of 30 to 50%, but then it fades. What's your sense, Andy?
Thanks for having me on. We're going to have to wait a little bit longer to see if this is the real deal, but I think odds are that it is. And I say that because things have been getting worse in the Chinese economy, and Xi Jinping is acknowledging that. And what we're seeing now is yet another step in a process of course correction towards pragmatism that's really been underway since September of last year. So it's not just a one-off thing if we talk about the February 17th meeting between Xi Jinping and the tech entrepreneurs. It's part of a process. And for investors, you can make a couple of choices. One is you can say, I'm convinced enough and I want to increase my exposure to China now. Or you can say, I want to wait maybe until March, just next month, when during the time of the annual legislative session, we'll have a lot clearer understanding of whether this is the real deal this time.
Andy, the big rally we've seen so far in China has been in tech names. And I think DeepSeek really shined the spotlight on some of the big innovations which are happening and, the capability in tech. And of course, also sharpened that point that China has not been for some years now just a low-cost producer at scale of things. But it's all been largely tech. Do you think that's the area to focus on for investors?
Well, obviously, right now, that's a good place for investors to be focusing. And it's interesting. If you look at the MSCI China Index, for example, it over the last 12 months has significantly outperformed the S&P 500, whereas the Shanghai Composite Index, which is almost exclusively for domestic investors inside China, hasn't done nearly as well. So right now you've got a combination of tech and, surprisingly, foreign investors getting more confident than Chinese domestic investors. So the real opportunity is going to be for the whole rest of the listed universe outside of the tech names. And I think that there's a very good possibility that we're going to see a rebound there. When Xi Jinping, assuming he does, do enough and say enough to make entrepreneurs believe that the regulatory environment is going to be far less chaotic, much more transparent than it's been over the last few years. When they believe that, they'll start investing and hiring in their own businesses. And since they account for 90% of urban employment, that means almost all consumers in China are either entrepreneurs or work for an entrepreneurial firm. And when confidence comes back that the regulatory environment is improving, remember that there's a tremendous amount of liquidity sitting in the Chinese banking system right now. Family bank deposits, and this includes a lot of very small businesses, those bank deposits have grown by almost 90% since the beginning of COVID. That's a net expansion in savings of almost 10 trillion US dollars. So to put that in context, that's more than double the size of Japan's GDP. So when people start to get their confidence back, they'll start drawing down on that savings. And we could really see spending take off, hiring take off, and possibly the domestic market take off as well.
Andy, from what you're saying, it seems that the sleeping dragon could be in the process of waking up and maybe a couple of quarters away from really breathing fire. But really, that's my next question. Given everything that you're saying and the very, very smart optics around that meeting that Xi Jinping had with Chinese industry earlier this month, when does this start translating into numbers, GDP growth, better industrial output numbers? What are you factoring in right now?
Well, I think if investors wait for the macro data to illustrate that people have really gotten their confidence back, they're likely to lose out on a big part of the rally because that macro data is going to take a while. It's going to take a while for this to be seen in everything from retail sales growth to GDP growth and household income growth. So I think the most important thing for foreign investors right now is to pay attention to what Chinese entrepreneurs are doing and saying and what Chinese consumers are doing and saying. And we'll start to see that relatively quickly if the Shanghai Composite Index starts going up, if Chinese investors have enough confidence to get back into their own market. If you want to look at data, don't wait for the GDP growth, which comes with quite a lag, but instead look at data for hiring, look at data for retail sales, look at data for wage growth in China, which all of those numbers come out on a monthly basis. The other thing that I would focus on are two data points. One I already mentioned, which is the household savings numbers. Those have been increasing at a steady rate for several years now. Even in December, the last month we have data for, those household bank deposits, which again include a lot of very small businesses, we're still growing at 10% year over year. When that starts slowing down, that will be a good sign. And the other thing to look for is the Chinese government's own survey every month of consumer confidence. That collapsed in 2020 during the Shanghai lockdown and has remained at all-time lows. When you start to see that tick up again, that's a good sign.
Andy, just 2 or 3 points. $10 trillion is household savings in China now, right? You're saying?
No, that's the net increase in household savings since the beginning of 2020.
Okay, we'll make
just
that,
the net increase.
Okay. Net increase in household savings is 10 trillion. Just two things. For viewers who can do it or investors who can do it and who can maybe access the US market, anything, do you have a top idea out of the China-listed stocks there?
Well, I'm the macro guy, so my focus is on what's happening in the Chinese economy and US-China relations rather than the individual stock names.
Okay, all right. Well, we'll leave it there. Short on time, but not out of questions. So maybe next time. Thank you very much, Andy, for joining us here on CNBC-TV18. But that's an interesting conversation with somebody who's actually spent a lot of time in China, knows the inside outs there. Well, let's just focus on a couple more stocks. L&T Tech Services stock's been doing well. Rima is here to focus in on that. Rima, morning.
Thanks so much for that. So L&T Tech Services is higher because Macquarie today has upgraded it to an outperform from an underperform and raised the target price to 6,530. They acknowledge that growth for the company will be below peers, but valuations are now attractive. It's trading at a steep discount to peers, at an 11% discount to Coforge and a 30% discount to Persistent. And even if you look at the one-year stock price returns, Persistent has raced away with a 38% up move. Coforge is up nearly 17-18%. In that comparison, LTTS has lagged because its growth rate has been underwhelming and therefore valuations are now at a discount. Macquarie believes that there is a possibility that growth could pick up for LTTS going forward given the acquisition. And the two catalysts they will watch, one is on margins getting back to 16-17% and a pickup in growth. Back to you.
All right, Rima, thank you very much for that. Let's look at the other stock that's been reacting to brokerage notes as well. This one is Bandhan Bank reacting to a CLSA note. Abhishek, what is CLSA saying?
Well, CLS has upgraded the stock to high conviction outperform from outperform rating that they had earlier. Now, target price is the same at about rupees 220 per share. Now, they say that the play on MFI recovery cycle with gradual migration to secured loan is happening in Bandhan Bank. So, the new management intends to increase the share of secured loans over the next 2 years to 55% to 60% from the 50% that it is right now. So, the early signs of improvement in collection efficiency is seen, and Bandhan Bank is well placed with respect to benefiting from this recovery. So the asset quality cycle has been better than peers for Bandhan Bank. The entire management team is new, so they don't see a risk of kitchen sinking in the coming quarters as well. So they upgrade following a 20% correction over the past 3 months. They expect Bandhan Bank to deliver an ROA of about 1.5 to 1.6% in the medium term, which they believe is similar to Axis Bank. However, the net interest margin profile of these two lenders are different. Bandhan Bank has a net interest margin of close to 7% and Axis Bank about 4% in Q3 FY25. Back to you.
Okay, all right, Abhishek, thanks for that. But L&T Tech and Bandhan Bank are outliers, and otherwise what is turning out to be a weak market and a weak morning. As we take the break very quickly, the Nifty is down 0.4%. The mid-cap index has lost its mojo. It's also negative now. And the Bank Nifty is actually sliding a little more, down about 0.75%. So weak morning. Let's see if the bulls manage to come back in. Take a break. On the other side, we will put the spotlight on commodities. Welcome back. Mid-cap index sliding more than the Nifty now, so need to keep an eye out on the screen. Equity is a little shaky here this morning. Let's find out what's happening in commodities. Manisha is here, as always, with the latest. Manisha, so what's captivating your imagination this Friday morning?
Well, sugar, let's get some sweet in on this Friday morning. And if you look at the prices itself, they have been gaining. I'm talking about sugar right now because in this week itself, we've seen prices gain up by nearly 3.5%. For the Indian markets, the prices have gained up by 6.5%. So when you look at Maharashtra S30 grade, that is what we consume, by the way, the prices really have gained up in the last couple of months from 3,360 to 3,800. The cost of production still is around 3,950 to 4,000. And if you are exporting sugar, the pricing that the markets are getting is at 4,300. So that really is the maths coming in out from there. When you look at the global sugar prices, well, they are trading above 21 cents a pound, which also is a 2-month highs. So whether it is about Indian markets, Brazil, Thailand, the major producers, and US, we have seen the prices continue to gain up. The reason that you are looking at prices gaining, one, the reason comes in from India itself, because we've seen output decline by 12% on a season-on-season, year-on-year so far. So that clearly has been supportive. Apart from that, while India has reopened sugar exports, in the international markets, that 10 lakh tons doesn't really mean too much. For the Indian markets, though, when we are looking at a lower crop as compared to previous year, the 10 lakh tons going out of the country has taken the prices on the higher side. Out of this 10 lakh tons of export, which has been allowed by Indian government, 2 lakh tons, the industry tells us, is already exported and 3 lakh tons has been contracted. This, remember, is open until September 2025, so there is still a lot of time for them to export this. Apart from that, apart from India, for the markets, it also is about the sugar mills in India closing early due to cane shortages. So within India itself, there are various reasons that you have seen leading to increase in prices. For the global markets, it has to do with Brazil, where we're looking at average rainfall declining, and that's weighed on the crop. Unica says that 5% of a lower side on crop is what they're estimating for this year coming in from Brazil as well. Interestingly, when it comes to India, while we are looking at a lower crop this time around, last time was 32 million tons. This time, if you look at various Indian associations and companies, they are putting the crop estimates on the lower side. 272 is what Ismail said. 270 lakh tons is what National Federation of Sugar talks about. 265 is what ISTA is also saying. So we are looking at a major gap when it comes to sugar output expectations itself. When you look at some other agencies and companies as well, they're talking about output at around 268 lakh tons. 280 lakh tons is what Mere Commodities seems to be talking about. So the lowest is 264 and the highest 280. And within this, you will see a sugar output coming in for this year. Last year was 332. So we are looking at much lower sugar production this time around, and that clearly has been supportive for prices.
Right, Manisha, thank you very much for that. That's Commodities in Focus. We're going to take a quick commercial break here. It's our special segment. It's the economy. Lata discusses, global macros. Andrew Chilton of Goldman Sachs is her guest, and they talk about how tariff threat impacts Asian economies and their currency. Stay tuned. Coming up.
Welcome to It's the Economy. Tariff threats from President Trump are hitting the market with unfailing regularity. In practically every speech, the president makes it a point to threaten India with reciprocal tariffs. Now, how much higher will tariffs go? Which sectors are vulnerable from a stock market point of view? And what's the impact on India and Asia as a whole? Impact on currencies? I have with me someone who's an expert on all these issues and has written an excellent report, Andrew Tilton, the chief Asia-Pacific economist at Goldman Sachs. Andrew Tilton is with us in the studio, and thank you very much for that, Andrew.
Thank you for having me.
Okay, well, let me start with the serious stuff. The impact of reciprocal tariffs. It's very confusing. Will it be product by product? Will it be, one for the whole, world? That everyone gets a steel tariff, everyone gets. How do we think about this tariff?
Well, we expect to see reciprocal tariffs imposed probably in April. President Trump has asked for a number of reports and analysis and expects to make a decision in April. As you noted, it could be making the overall level of tariffs equivalent or product by product. Now, we've calculated that in the case of India, the former would add 6-7% to tariffs, U.S. tariffs on India, whereas the latter, that is product by product tariffs, could ultimately mean an increase of a little over 10%.
Okay. So in that case, what should India be worried about in terms of a GDP impact in either case?
We expect an impact of between 10 and 30 basis points, so not a huge impact. India's exports directly to the U.S. are about 2% of Indian GDP, so it's a manageable hit. India is a large, relatively closed economy, so we think this will not knock India off a reasonably strong growth trajectory.
Okay. No, that is a consolation. But, let's look at it practically. Is it, after all, we have an Elon Musk and a Doggy, which wants U.S. to reduce the size of government. Will it be practically possible for a customs department to look at product by product, country by country, and even administer this level of tariffs? So practically, what should we expect?
On the analytical side, it's pretty complicated. If we're going to match product by product tariffs, and it's not just India, of course, we're talking about doing this for the whole world, that could delay the implementation, perhaps to mid-year or even later in 2025. In terms of actually administering the tariffs, I mean, we do have, as you noted, a customs service, so the machinery is there, but the implementation of all the various tariff codes is going to, and figuring that out for each country is going to take some time. I just add, this is, I think, not likely to be an issue for India, but the so-called de minimis tariff, where you can send in packages under $800 directly to U.S. households without any tariff, that's going to take some new machinery because our postal service doesn't normally charge tariffs, but that's likely only to affect China.
Oh, okay. That's a separate problem we didn't think about. But even coming to the tariff, assuming it's product by product, or even if it's assuming it's on a country, but it is a little punishingly high, won't people dodge it pretty easily? I mean, having a trading company in Dubai or some other country which is not similarly punished and routing it, these things will... I'm just wondering if the tariff threat is as big. The market is really scared.
Well, we've seen already from the first trade war in 2018 to 19 that there was a meaningful trade rerouted from China to third countries, Vietnam being an obvious example, where we see an increase in Chinese exports to Vietnam, increase in Vietnamese exports to the U.S., and, of course, potentially saving tariffs. Now, I think the impact of that, first of all, is that there's a risk Vietnam faces tariffs down the road from the U.S. But as you noted, it is possible we could see some rerouting as part of this global trade shift and these tariffs imposed by President Trump. That will likely mean there are potentially future actions or efforts to trace back products to their origin. So that's going to increase the complexity of this over time.
Okay, now some more micro questions. Which sectors in India would you worry about?
Well, in terms of sectors that might see lower tariffs in order to stave off the increases on the U.S. side.
Yes.
I believe we've already seen some cuts in motorcycles,
Big
electronics.
cuts in motorcycles.
So those would be a couple of areas that would be affected relatively sooner. I know there's been some discussion of autos potentially. So those would be a few that I think are in focus, not just for India, but more generally from the U.S. perspective.
These are industries or companies which will face foreign competition, right?
Yes.
And therefore, makers of electric cars or makers of bikes better watch. There could be competition, though, of course, their products are pretty expensive even without tariffs. What about Indian exporters getting hampered because they have been priced out? Or do you think they're priced at last?
Well, I think that it really depends on the sector. I mean, we're seeing, in some places, President Trump, for example, talking about tariffs on semiconductors. I mean, less of an issue for India, but I think not likely to have a big impact on U.S. demand. Whereas goods that, as you said, are more elastic, if we're talking about apparel, something like that, differential tariffs on one country could cause a shift in demand to another. So I think some of the Indian exports to U.S. would be in those categories, and we could see a modest shift. But of course, we're seeing U.S. tariffs potentially on the whole world as a result of this reciprocal tariff initiative.
So if it impacts us, it impacts Bangladesh as well. Probably it will impact other apparel competitors. Would you therefore say that, when you look at India and look at our GDP, and recently you'll have upped the forecast, you worry more about domestic India, right? The consumption story in India or the capex story in India is more important for us to track than tariffs, would you say, when you are arriving at the GDP?
Yes, the external environment has been better. This is obviously a difficult time, both from the standpoint of competition from China as well as the potential tariffs from the U.S. But we really focus more on the domestic economy when it comes to our India growth forecasts. We have a reasonably optimistic view looking out a few years. We think the economy can grow 6.5% or better. But recently, the combination of fiscal tightness and so far only one rate cut from the RBI means that the domestic economy has been under modestly tighter policy in the past year.
Yeah, but you just released a report upping the forecast for, I think, the last quarter that went by and the current quarter.
We made a slight tweak based on the fact that it looked like government spending had accelerated in the late 2024. And that it should boost Q4 growth. We took a tiny bit out of Q1 as a result. So I wouldn't call this a major shift. It's more a timing question.
Every little bit helps. That 5.4% GDP growth number for July, August, September has rattled us. So even if you're going to, up it to 6.3 or 6.4, that your number is, it's welcome. Let me look at the currency aspect, which has rattled foreign investors a lot. Do you think we are done with it? We had the Reserve Bank bulletin indicate that the overvaluation is substantially lower. In November, it was 108, indicating 8% overvaluation. The last bulletin said it's only a 4% overvaluation, 104. So you think the rupee is done with its serious depreciation?
Yes, largely. We have a forecast that's essentially flat over the next 6 months. We did see clearly, as you noted, a correction. And in light of efforts to boost manufacturing in India, the Make in India initiative, it's probably better to be more aligned with those currency valuation metrics rather than being overvalued. I mean, again, according to that metric, the challenge of exporting in the current environment with both, again, China competition and potential tariffs means that, overvaluation would be a third challenge India doesn't need.
No, absolutely. I mean, I don't think the Reserve Bank would normally want it. It was perhaps just a brief period when, for whatever reason, the rupee got overvalued. And maybe perhaps Trump's election and his subsequent announcements were unexpected. But what's the range? Is it like 87.5 or 88? There are people even talking 90. So what's your expected range?
Out 6 months, we have 87, and then slightly higher, 87.5 in a year. So it's really quite a small shift from where we are currently.
87.5, we have been there, done that. And now strengthened to, I think, 86.8 levels. What's your sense about Reserve Bank rate cuts? And now, do you think it's tough, or because the currency challenge is over, they now have more space for rate cuts?
Well, we think they were prudent to wait in light of uncertainties around both the trade environment as well as domestic inflation. But we do expect at least one more cut in light of the recent inflation performance and the fact that growth is slightly below, I think, policymakers' aspirations as well as our estimates of trend growth.
Oh, yes, aspirations are to touch 7, but, that happened only for 3 years after COVID. What's your sense about the U.S. Rate cuts? Do you think we are done with it, or can we expect the FOMC minutes did sound hawkish? So do we have a cut down?
We have 2 cuts in our forecast this year, one at mid-year, one in December. That said, I would say our conviction on this is not especially high. It's clear that the Fed is going to be on hold at least for the next couple of months. They don't know, neither do we, what President Trump exactly is going to implement over the next few months, and that will clearly matter for the U.S. outlook and the Fed. We've also had, I'd say, some mixed data recently, a softer retail sales report, which probably was due to weather issues in January, but nonetheless has raised a few questions. So the Fed will likely want a little bit clearer read on both the domestic economy and on the new administration's policy before making any further moves.
What's your sense? I mean, this is more a market man's question, but then you advise your markets team. This U.S. exceptionalism, money being pulled out of every emerging market and rushing to the U.S., does it taper off? I mean, we did see a fall yesterday, but does U.S. Continue to be a magnet?
I think there are a couple underlying drivers of this U.S. exceptionalism. One is clearly tech, AI, the excitement about the Mag 7, as it were, the inflows of equity investment from the rest of the world to be a part of that. That will eventually fade. I'm not going to tell you exactly when it happens. I wish I knew, but we think the investment boom in chips, in AI investment continues into 2026, so we don't see any immediate end for that inflow. And then there's the dollar, which is benefiting both from that trend, but also from tariffs. We would typically expect a country that imposes tariffs on others to have its currency appreciate. And we've seen that when markets have gotten more worried about U.S. tariffs, the dollar has tended to appreciate. Right now, I think there's been a little bit of relief that we haven't actually had more tariffs imposed.
Yes.
But, as we've been discussing earlier, I think it's likely we see tariffs imposed sometime in Q2, and so we would expect another leg higher in the dollar. So to answer your question, we think we probably still have a little bit more U.S. exceptionalism, at least when it comes to the dollar, over the next few months.
For a better part of 2025, we have to tackle Europe, U.S. exceptionalism. Any range for the dollar index?
Well, the amazing thing is we're at a 40-year high, or very close to it. We recently hit a 40-year high in the dollar on a broad trade-weighted basis. So looking out a few years, we would expect the dollar to depreciate, but we think we have to get over the hump of tariffs first. The last round of, if you want to call it, global tariffs probably need to be clearer in the mind of the market before we can be comfortable that we've peaked on the dollar.
Okay, so it's possible that smart money comes back to emerging markets like India before 25 runs out.
We could see that, yes. I think we could see a better environment for EM. Typically, that's been the case, when the dollar has peaked and when we've been in the Fed easing cycle. Tariffs are probably the most important factor impeding that right now.
Okay, well, let's hope so. On that optimistic note, Andrew Tilton, thank you very much for joining us in our studio.
Thank you.
So there you are. There is the immediate tariff hump, but hopefully by the end of the year at least, U.S. exceptionalism would have peaked off. That's it on this edition of It's the Economy. Thanks for watching. After a break, Chartbusters.